Welcome to the Two Stewards Show. These days, real estate investments often require some kind of strategic renovation. Not only are you carefully picking a property with a ton of potential, you're also going to be taking that underutilized property and maximizing it by adding dwelling units and upgrading things to achieve more rental income and increased property value. But here's where it gets tricky because, as it turns out, renovations cost money. And unfortunately, getting workers to come to your property to do work on it is near impossible unless you pay them. So chances are you may have enough funds to buy a property, but you may not have enough funds to pay for the renovations. So you sit there and you wait and you sulk. And if you're emotional about this sort of thing, you cry. And if you're really emotional, you start listening to the Two Stewards Show as a diversion. And lo and behold, the answer comes across the airwaves. Today, we are joined by Lorenzo Podda of Better Mortgage Select. Lorenzo is going to break down a new financing program that allows waiting, sulking, and even crying investors to dry their tears, open their eyes, put a smile on their face, and get going. This is huge. This is exciting. This is game-changing. So if you've been sitting on the sidelines during one of the best buyer's markets in recent history because renovation funds have been holding you back, then keep your ears open. And if you want to see if this financing option is a great fit for you, you can reach out to Lorenzo at bmselect.ca. Tell him that the Two Stewards sent you, or you can always reach out to Mark or myself at twostewards.ca. Remember, this show is not financial advice, but it is valuable for listening amusement purposes. And now, Lorenzo Podda.
What do they say? Second time's the charm, Brent?
That's right.
Yeah.
We're actually live. We're recording, got audio, video, everything.
Like the buttons say that we're recording.
All right, good.
I'm gonna go with that. Yeah, it says recording. Look at that. So
it would be no big deal if it was just us, Mark, but we have Lorenzo here. Lorenzo Podda.
So yes, we have Lorenzo. Is it Lorenzo the Great or Lorenzo the Magnificent?
Whatever you like. I'm easy.
To the podcast series on the Medici.
Oh yeah.
And there was a couple of Lorenzos in there.
Yes, it's a popular name over there.
So I don't know. He's pretty great. Welcome to the show, Lorenzo.
Thank
again.
you.
So first time we did this, I forgot to hit record. So
it's great to be back
again.
Yeah, Lorenzo's being very generous with his time.
Yes.
It's great to be back.
Okay. So yeah, welcome. Lorenzo, you're from BM Select.
Yes.
You are a mortgage broker.
Correct.
Describe to us quickly what a mortgage broker does in case anybody doesn't really know.
Yeah, so effectively our job is to work with clients, borrowers, someone looking to buy a house, refinance a house, whether you're an investor, a first-time home buyer, just sell and buy any type of real estate, even commercial residential or regular commercial properties. If you're looking for some sort of debt or financing on that property, it's our job to work with various types of lenders, banks, B lenders, private lenders, whoever it may be to best suit your needs to help find the financing that someone needs.
Okay. And so, yeah, Brent, you have worked with BM Select a fair bit, I think, right?
Top notch, man.
Top notch.
Top
okay.
notch.
This isn't just some schmuck off the street. I mean, he may be a schmuck, but he's not off the street.
Yeah.
Okay. So,
that, he's, so you said you get financing on properties, but that includes construction.
Correct. Any type of debt.
Right?
Correct.
So,
construction financing as well.
So it's not just purchasing, refinancing. It's someone looking to finance a construction project.
Correct.
Yeah. Okay.
Yeah. And we got some, Lorenzo has some pretty cool programs we're going to dive into, I think. But first, I don't know if we want to just talk about the market a little bit. I don't know. We can do predictions here, Lorenzo. But did we hit the bottom, do you think, of the housing market in Ontario?
Well, do you guys follow rates pretty closely? Like,
every day. That's all we do.
Okay.
Yeah,
because that's a big question with mortgages. Like, hey, what's the rate, right?
Yeah, exactly. So, in terms of rates bottoming out, we're starting to see over the past couple of months, fixed rates probably about a month and a half, 2 months ago did start to bottom out. We were pretty comfortable getting people a rate starting with a 3. If you're buying an owner-occupied property, your rental is a little bit higher, but someone purchasing a principal residence was could be pretty confident about 2 months ago they were going to get something starting with a 3 or very close to it.
Wow.
And that was kind of happening pretty consistently. We then saw a spike in the bond yields, the government bond yields. So for those that don't know, that's how the fixed rates get priced in Canada. So as the bond yields increase, you then start to see fixed rates increase as well. We saw a spike in the bond yields about a month and a half, 2 months ago, maybe a little bit less. And that obviously started to shoot some fixed rates up. So we have seen a bit of a bottoming in terms of rates. We've also seen the discretion on variable rates. So borrowers who are getting prime minus 0.6 or 0.5 or 0.8, or some were getting minus a whole 1%. That's starting to kind of shrink as well. So we're starting to see a bit of a bottom on rates. There is some room to go on the variable side. The Bank of Canada will definitely at some point in the next 12 to 18 months have to cut rates 1 to 2 more times. Some banks are predicting even more. But the fixed rate side, it's been kind of steady in terms of we might be in something where it's a little bit of a holding pattern for the next year or so.
Well, I think RBC just came out and I can't remember her name, but one of the analysts there, is it Francis maybe, came and said no more rate cuts this year. So
yeah, I could see that. So
bold,
some of the banks started
direction.
off pretty bullish on the rate cuts, thinking, hey, we're going to drop to by 0.75 a full percent. Our stance was always that it's all about watching inflation, right? So as inflation was coming really low and starting to lower, you're seeing like 1.6%. Well, it was like 1.6 was probably our bottom out roughly. And so we were like, yeah, no, they definitely have some room to start dropping rates. The last 2 inflation reports that came out, headline inflation. So that's kind of the one that everyone sees when you open your phone, check Twitter, or check X. That's the one everyone sees was coming in about 1.7%. And so that right away should signal a rate cut. The problem is when you start to dive deep into it, core inflation, which is another measure of inflation, but it excludes gas, excludes energy prices. That came in at about 2.8%, so almost at 3%. And so what happens is because the price of gas dropped so much because of the carbon tax, that was bringing the overall inflation number down. But the Bank of Canada, they've come out and basically said, and we've talked to people that have actually worked at the Bank of Canada before, they've basically said their mandate, whenever they're looking at all the factors through an economy, the biggest one they put kind of stock into is core inflation, whether they're going to drop rates or not. So as soon as you start to see core inflation peak up where it is right now, that's when you start to see, obviously, Bank of Canada having some trouble lowering rates. So when the banks were getting a bit more confident that rates were coming down, and some of them were kind of starting to veer off that, we kind of veered off that right away too, saying, look, if core is staying this high, it'll be very tough to drop rates. We're kind of in that pattern right now, but eventually, because the economy is a little bit weaker right now, the jobs market isn't great, our productivity and GDP isn't very good, they're going to have to do... Yeah, we'll get into that, I guess.
Isn't very good, or is very
terrible.
poor.
It's abysmal.
Okay.
But yeah, they're going to have to drop rates at some point. But it might be something where it's kind of done slower just to try to obviously keep inflation from getting out of hand as well.
Well, I think a big part of core inflation is shelter, right? I think that's like a very
well, that's
large
in regular
part.
inflation, correct? Yeah, core inflation is regular inflation, just taking out basically it's energy and then food sometimes as well.
Yeah,
so gas and food.
Yeah,
so stuff that we really don't have much control over because all of that's imported.
Yeah, and so as we see most people getting increases in their mortgage rates, because as the 5 years are rolling over, right, the 3 years would have already done. So
correct. Yeah,
everybody's paying more for their mortgage.
Right. It's the people may have heard about the renewal cliff that came up for 2025, 2026. We had such a busy time in the real estate market, 2021, 22 even, where that was all renewals who people took 5 years now starting to mature. Those people are going from 1.5% to 2% rates to now 4.5% to 4% rates, somewhere in that range. So that jump obviously is going to start to obviously change the shelter costs as well.
Yeah, it's
So are you seeing a lot of these renewals come up and you're seeing a lot of pain?
It's not, honestly, it's not too bad right now in terms of the people coming up for renewal. We're doing a lot of things to help with the payment struggle for a lot of borrowers. It would have been probably a lot worse had this renewal cliff kind of started maybe 2 years ago or a year and a half ago when rates were way higher. But we're still seeing obviously some pain in it, but there's a lot of things that we can do that we're helping people with to kind of manage that, because it's all about, at the end of the day, for a lot of borrowers right now, it's about managing your payment. So we have a lot of people coming to us saying, hey, my amortization, I have less 15 years, for example. I can't have my rate go from 2% to 4.5%. What do I do? Right. So we're working with them. We're restructuring their mortgage, maybe re-extending that amortization back to 30 years, keeping that payment almost kind of similar to what they were already paying. So at least they can kind of cope over the next little bit. But also, and this obviously we want to teach people as well is the key is just extending amortization and everything's okay. That's a great tool for the short term.
That sounds like a page out of the government's
it's
how far can we kick
this can down the road? Yeah, so it's a great tool for the short term, and so it's definitely something we want to use. But then also part of it's education on, okay, let's get comfortable with the payment now and slowly start trying to either find ways to increase it or find ways to utilize the bank's prepayment rules so that we can then obviously take that 30-year amortization but still pay it off much quicker while keeping our cash flow obviously at a minimum, at the where it needs to be.
Well, I guess the hope would be that maybe wages will start to catch up with assets.
I don't think that's going to happen ever anymore, unfortunately. I think that ship sailed.
But at least maybe a better rate of
Lorenzo is bullish on
Canada.
Not that I'm too bearish on Canada. I just think the idea that we've gone so hard with the money printing in this country, to be fair, in the Western civilization, we've gone so hard with money printing. Like, it's almost impossible, I guess, to have where all of a sudden wages are matching the rate of inflation or the rate of asset growth. Right? It's just it's not possible now the way they're printing money.
So what happens what happens to rates like bond rates, government bond rates, when they print a lot of money?
So typically, the yields will start to fall on those when they're starting to print a lot of money, called quantitative easing. Yeah. So what people have to notice is the yield. So the return that investors are getting on those bonds start to decrease. And so what ends up happening in the mortgage side of things, where most people, that's where hey, what happens to me then? When they have to print a lot of money, the yields start to drop on those bond rate or the bond yields. And then obviously fixed rates become lower price. So it sounds great for mortgage owners, but typically when they're having to print a ton of money, it signals there's something wrong in the economy. So the easiest way I explain it to people is, look what happened at COVID. COVID started off, there was something wrong with the economy. People were losing their jobs. People were scared. The government came in, printed a ton of money. Rates came down, right? Great for real estate, but obviously a lot of other pieces of the economy were hurting there. So it just kind of depends where you're at in kind of the overall economy. If you're a homeowner or you're someone in the stock market or someone that just has a regular job, just depends where you are, how it'll affect you. But typically when you're printing money, rates start to drop.
Well, because I have a theory that we're going to see a big old wheelbarrow full of money.
Is this the Cricky curve?
Yeah, that's right. No, that I think the Liberal government is going to print a ton of money soon.
That's what they're famous for. So
yeah,
surprised.
You don't have any inside scoop there.
Yeah,
I mean, at the end of the day, like, to be honest, it's more just looking at history, right? Like, at what time has a Liberal government not printed a ton of money? Right? Every government prints money. This being fair, but I mean, like, Liberals seem to just on average do it probably a lot higher of a percentage than the opposing.
Well, and they've signaled too, right? Yep. Like with the no budget, that was a good one. But even with that, there were still some numbers, and we're seeing like massive deficits. But I think we're going to see over and above that.
And the one thing I saw too is when the election was actually happening, just look through their plan. And so the Conservatives came out with the plan, and it was more to kind of get more jobs, open up the economy, kind of more of a free market economy. The Liberals say, hey, we need more housing. No worries. We're going to put $100 million into figuring out a plan. We're going to put $150 million into figuring out a plan for oil, right? It wasn't an actual plan. It was a commitment to spend money. Yeah. So that's all their plan was every time, was just a commitment to spend more money. There wasn't actually here's what we're going to do. It was, we're just going to throw a ton of money at it and fix it. Well, that's printing money.
I mean, it does stimulate the economy somehow.
Yeah.
Right?
No,
Somebody's getting that money.
Yeah, listen, I won't complain at low interest rates. I'm not complaining.
But on interest rates, like historically speaking, we've seen a decline in rates over the last 30 years, right?
Yep.
Do you think we're going to have those low rates? I say low rates because I don't know, in the last 10 years it's been
what's low?
Yeah, like what do you define low, I guess?
%, but like during COVID, that whole time of that frenzy, right, where it was like 2%, like people were getting 1 point whatever, right? And do you see that ever coming back? Where do you see us kind of?
Barring any sort of like financial disaster, pandemic, great financial crisis, I get
trade wars,
massive trade. It would have to be a pretty big trade war. Like, to be honest, it has to be like a massive trade war. Like supply chains completely screwed. Like, it was barring something pretty catastrophic that the right history books about. We're probably not. I don't see a world where we get back to that 1% and 2% interest rate. And I do think a normal at this point for the next kind of 5-year period. I think probably an average 5-year fixture, you'll be somewhere between 4 to like 4.5% is probably the new average 5-year fixed over the next 5 years. So I think that's where you're going to start start leveling off, and that's going to be kind of the new normal for a lot of Canadians.
I think that's just good to keep in mind too. Like if you're an investor and you're kind of getting into the space, like in the last couple of years, like maybe this is shocking that it's like double what it was 2 years ago, but like you're just basically saying like take the rate, like it's gonna be good. Like if it goes to 6, well, you're gonna be thankful, right?
Exactly. So, and I don't even think it's necessarily going to go to 6, but I definitely don't think it's going to. I think
it's
I'd
not
be fair.
Gonna hover down.
Yeah, I don't think it's all of a sudden going to start climbing down to 2 unless something crazy happens.
Well, I got to refinance a place in the States, and I'm hoping to get to 6. So
yeah, there you go.
We'll see.
But your mortgage is probably your property value is probably a lot less, or your mortgage is probably a lot smaller than would be here for that property.
Yeah, 100%. And by the way, folks, this is not financial advice.
Yeah.
And especially when it comes to mortgages. But if you want it, call Lorenzo and he will give you some financial mortgage advice. So, okay, let's just talk about markets quickly. We talked about rates. We were talking before the show about condos and specifically the GTA condo market.
The GTA bloodbath.
Right? I was talking about Niagara Falls, but the GTA bloodbath. Like what do you see in there, Lorenzo?
It's tough for a lot of people right now. Like on average, what we're seeing in the GTA specifically.
I want names. I want addresses. I want the stories.
More details.
On average, we're probably seeing like it's now my upfront talk with clients is because obviously with every type of client, you have kind of an upfront conversation is what we do in our business and just figure out where they're at, what the plan is. So most of the times now in those condo conversations, a lot of our sales guys are basically telling me a lot of stuff I'm telling clients is, okay, well, looking at where it is, looking when they bought what they bought for and say, hey, be prepared. It might be 20% less than what you bought it for. And we're starting to see
appraisal.
On the appraisal, correct. Yeah. When it's time to get that appraisal on the property, it might be about 20% less than what you bought it for, meaning that you now have to find a way to come up with that 20% because the builder's still saying, give me my $1 million. And the bank's only saying, well, I'm going to loan to you based on $800K. So I'm only going to give you $640. Right. So now you got to figure out how to come up with the rest. Right. So it's definitely something that's been a pretty big challenge for a lot of people. And it's just the fact, the market right now, they built a ton. The market's obviously taken a beating, tons of supply out there for the condo side. So it's been pretty tough for a lot of people. We're working through it. There's a lot of different tips and tricks we can do to help people with that as well. So that's something like the one thing I will tell anyone who has a condo coming up in the next 12 months, even more, just get ahead of it, start calling whoever your mortgage person is, explain to them your situation and just start putting a plan in place. Because the best thing you can do is at least have a plan of how do I get this done versus showing up a week before. Now you just got to take whatever's thrown at you to get it done. Right. And so putting together the plan is massive. So that's the biggest thing I would definitely be recommending to a lot of people because it's been nasty out there, to be honest.
So the intention of a lot of these investors, I mean, I'm not going to mention names, but it's pre-construction. So you're buying this thing, you're anticipating that it's going to go up in value before you close. And then you're going to what's the exit strategy a lot of people are banking on?
I mean, just the numbers show that condo sales in the GTA were overwhelming investors, right? Yeah. This was not like first-time home buyers. By and large, it's almost all investors.
Yeah, they were buying on, most people were buying on complete speculation, like a stock. And imagine buying any sort of stock at ridiculously high leverage. That's basically what people were doing, right? They were putting in $60,000 to buy a $700,000 condo or $70,000 to buy a $700,000 condo, expecting that condo is going to be worth $900,000 on closing, and they turn $60,000 into $200,000. Right, because now they're just going to flip it.
They can do an assignment.
They're going to flip it on assignment. They won't even close on it. They're just selling paper, right? And so that was the hope for a lot of people. Obviously, it's not working out that way for a lot of people. Some people were just buying it, and honestly, it's wanted the good investment class. Figured real estate would be good in Canada, and now you know what? They're able to close on it, but now they're underwater like $2,000 a month instead of the $500 a month they thought at first, right? And so that monthly payment's now killing them. So there's a little bit of stuff like that as well. But the guy, like people are bought on just pure speculation, trying to assign it. Had zero intention of closing. Those people are in a bit of trouble right now.
So are you seeing them walk away, or they're
seeing a little bit of everything now? So we're seeing. So it's a little bit of everything.
Well, because you forfeit the deposit, but you also liable. Like someone could.
Well, yeah. So I've had people going, like we've had ones where like we figured out a way to get them to close. It's not pretty, but you know what? Like they're gonna close and not get sued, right? And so we figured out the best way to get them to close. They're sitting there. They're like, yeah, I'm going to have to close and kind of we'll deal with it after. And all of a sudden we'll get a call and say, listen, I called the builder, called my lawyer. we're just walking away and let them come after us. Or we've made a deal with the builder somehow to get out of it. They're going to keep our deposit and we're going to forfeit something else. So we've seen kind of horse trading with builders now, which is crazy on how to let them out. Some builders like they're not obligated to, right? No. So sometimes they're like, no, we're coming for you, right? And so it depends who your builder is. But yeah, it's been tough out there. There's been honestly like stuff that in 20 years you wouldn't see, like you've seen it now, right? Yeah. Like I've had, again, I was telling you before, I had a guy in quite literally like any option you looked at, it was impossible for him to close. He had no family, no relatives, no friends, no co-signers, no job, no down payment. Like he only put like it was just crazy how we
Who
got.
Who is this guy?
Yeah,
is he a citizen of Canada?
Yeah, he got started on it. And his plan was literally just to flip. He thought he could make a quick buck. Like he had never been in real estate before, and it was like his only option was bankruptcy. Like there's no, if they come after you, just go bankrupt. There's nothing you can really do, right? So yeah, there's been some of those, but there's also been some good stories too, where you get people right coming in. Like we did one last year where they had bought so long ago, the condo came in higher and it went well, right? Oh, wow. But they had bought, to be fair, they bought so long ago, the condo took a while to get built. Yeah. So the market still did, even with the drop, they were still okay. And also we have investors that are picking up condos right now at good prices, right? And so there's two sides of the coin. The guys who are trying to close probably aren't having a great time, but the guys who are saying, hey, look, there's blood in the water. They see that there's next to no starts happening right now, so clearly
that's the other side of the story, right?
There's likely going to be a supply and demand imbalance on the demand side now in 5 years from now, roughly. And so people are saying, hey, if I pick this up now, I know in 2030 that because there's no starts right now, there's going to be no new completions coming up. And so maybe now all of a sudden I have a way to get in, like obviously make a quick buck or get in on the market at a good deal, right? It's still, at the end of the day, if you have real estate in one of the biggest cities or metropolises in North America, you're still going to be okay. It's just time.
Yeah. Now, when you say no starts, how many starts do you mean?
I mean, very few. I don't know the exact number, but I can tell you, put it this way,
pretty close to zero.
Very, very, not zero, but obviously very close. I can tell you, we work with a lot of builders and I work with a ton of builders and they're all coming. They're like, hey, we're launching our projects. We're helping getting the marketing started and everything like that. Months go by, haven't sold one yet. Months go by, we're 10%. Like they can't get shovels in the ground because they haven't sold enough units yet. And it's happening like across the board. Some people are just delaying it too. I've had builders say, yeah, I'm just going to wait. Yeah. I'm not even going to try to sell this until a year from now, see if the market's better. Yeah. Right.
Yeah, I guess the one problem they'll have is like their crews, right? They want to keep the guys building. So when it's time to actually be busy, they actually have some labor. But so it's a bit of a tightrope for them to walk.
Yes.
Are you seeing any? I think we saw it in Hamilton here, if I'm not mistaken, up Stone Church by the Home Depot. I feel like that builder converted from condos to rentals. And because I know who that is. I live up there. Yeah. No, they were always rentals. That was always rental. Oh, they're for rent now.
That one was always rental.
Oh, was it?
That was always. I know that. I actually know that builder. Funny enough, so that was always rental.
Okay.
Yeah, that was a rental deal for them. But they were selling all around it though. They were selling all around it.
Oh, okay.
So yeah, so a lot of builders now, and smartly so, to be honest, from their perspective, is the government and CMHC has come out with some really good commercial financing packages now, like the ability to get to like 95% loan to value, the ability to get a 50-year amortization, and financing to actually build the deals as well on these commercial 5-unit and more type properties, and they're all multi-res. And so builders are now saying, well, to be honest, if I'm going to get most of my money back from the build, like right in pocket from the government at a fairly decent interest rate, I can rent it out in cash flow. There's probably no point in me selling the place. So it's more incentivizing them to keep it, rent it out. We're providing affordable housing still. So yeah, a lot of those, like the government programs that have come out and some of the stuff that we're able to finance right now, it's been a lot more attractive for builders to keep their condos and not actually condominiumize it, keep it as an apartment and rent it.
And yeah, you know what? In 5 years, maybe they
switch.
Go the condo route.
Yeah, you can always switch, right? But it's also something where it's like, just keep renting it, right? Just keep paying down your debt and keep the cash flow.
Yeah, depending on your model.
Yeah, exactly.
I think some guys are probably
it's forced. A game the government saves the day, eh, Mark? It's definitely.
So I was just telling Brent about the Canada Strong Pass, I think.
Oh.
Whatever, that our glorious leader Mark Carney introduced.
This is the train.
The train, yeah.
So you can take the train for free?
The kids take the train for free.
Like the GO train? I didn't even hear about this.
No, Via.
Oh, okay.
So it's, they're trying to stimulate travel. And it just so happens that our family is like heading out to Winnipeg And I was, the wife was going to drive with the kids, and then and go for like 3 weeks, whatever. And I was going to like join them for a week or whatever. And like, you know what? Why don't you just take the train? And so we looked at it. It's like, yeah, it's way cheaper. Like when you're not paying for the kids. And anyway, so Brent was like, oh, so who pays for that? I'm like, Brent, the government.
Uncle Sam.
The government pays.
Yeah.
Come on. It's the government.
So you're taking my money to pay for your kids to go on vacation.
Yes.
All right.
Yes.
Someone might as well enjoy it, right?
Yeah.
So, oh man.
We wanted to get into
government.
some sweet programs you guys got. So
Yeah, we talked about condos, but like who buys a condo? Nobody.
I don't know, Mark.
we know.
Do you?
Wow, let's not get into that. But when it comes to like more single family stuff,
Yeah. So like
Yeah.
my big thing is investors, a lot of the time these days, you gotta, like, you're buying a house, you're probably going to do something to it to improve it.
Yep.
Either it's going to be some renovations to increase the value, or in most cases it's intensifying, right? Like you're adding dwelling units to the lot, maybe you're severing or whatever. And the trick a lot of people have is right now, like they're running stuck. They're buying, like maybe they have enough funds to close on the house, but to actually do the renovations, they run out of cash, and then like the whole deal falls apart, right? It doesn't materialize. So when you guys came out with this sweet program, I was really interested. So maybe you could tell us a little bit about like kind of the background, what you guys did to kind of bring this to fruition.
For sure. So we came out with so I guess it first started. So our brokerage, BM Select, it's very focused toward investors. We always had a niche with real estate investors. We work with everyone, first time home buyers, selling buyers, we work with everybody, but we always had a big stronghold in the investor market, and we were niche with real estate investors. So when obviously the market started to change, interest rates went up, investors kind of fled the market. It was tough for them to do anything, right? Cash flow was abysmal, values were crazy, so it didn't make sense for investors. So we kind of went back and started working with a lot of our banks and lending partners, and we're saying, okay, what's going to bring investors back to the market? What's going to make them obviously more able to do deals? And to be fair, what's going to also help them be able to provide more housing, right? Because that's again,
smile and be excited.
Yeah, and get like we got to kind of get this thing going again. So we came up with a couple different. We came out with the whole kind of.
I just want the government to listen, because this is how you fix Canada right now.
I thought it was the free train rides, but apparently not.
Yeah, that's not bad. But yeah, so we ended up coming up with what we call is our Better Mortgage Select Investor Edge program. It's a series of basically 6 programs. A couple we'll highlight today, and this is kind of stuff to help investors kind of get back into the market. So the main one and the biggest one that we're likely to see and we've already seen a pretty big uptick in people wanting to do it is our build up program. That's the name for it. And so effectively what it allows any homeowner to do, and this is only for this specifically right now is only for residential property, so 4 units or less. But what allows homeowners to do is to finance the renovation on their property based on an appraisal being done as complete. So we're coming to a bank, we're saying, hey, we're planning to do a renovation, we're looking to completely redo our basement, we're looking to add a garden suite, build more units out. The renovation is going to cost $100,000, $200,000, $300,000, and the bank will finance this for you prior to you obviously having to go and find the money yourself. So traditionally, what would end up happening on someone trying to, so let's take an investor, for example. Investor is trying to add a garden suite to their property. They don't really have much equity in their current home right now. Maybe they only bought it 2 years ago. And so before, what would have to happen is they'd have to go get either a hard money loan, find the bank of mom and dad, or scrape and claw their way to find the
promissory notes.
Promissory notes, the hard money. Yeah, that we don't know how good those went, right? Yeah, we'll get into that in a sec. Well, so we all know how good those went, but so they have to go, and that's where the promissory note bubble became, right? And go figure out a way to build their garden suite. Hope the value went up, and then go back to a bank and try to refinance it and get their money out and pay everybody back. So what we've kind of said is we got to stop letting the guesswork happen, because that's the part that's killing a lot of these deals. So
yeah, I just want to slow you down on that part, because that's a big thing, like the guesswork. And if you're an investor, one of the biggest questions I always get is like certainty and risk, right? Like, how do I know that if I do X, Y, and Z, it's going to pay off? Or right, like that's always the uncertainty of the deal. So it would be so nice if I could, before I buy that property or before I start renovating this garden suite in my backyard, like I actually know how much the thing's going to be worth at the end of the day, or what the bank will give to me and financing on it, right?
Exactly.
So that's like the big question that people always ask, like, well, if I actually knew that ahead of time, well, then I can run my numbers and see if it makes sense. And then I can go and, it takes kind of all the risk, I would say the excitement out of it, but
capitalism, baby.
There you go.
Capital.
Yeah. So yeah, the way we have gotten around that now. So basically what we're able to do. So let's say you want to build that $300,000 garden suite. You don't really have much equity in your home to get the kind of the project off the ground. We've been able to get the lender, as long as we can qualify you still. So still normal bank qualification, but assuming we can qualify you based on what your current mortgage is, plus the renovation amount that you're going to do. The bank will send an appraiser out and say, is this property going to be worth what they think it is when the renovation's done? If the appraiser says yes, the bank is then basically willing to finance that entire renovation amount for us. And all we have to do is come up with a small portion of the money to get the renovation started. So about 15% of the actual renovation cost, we have, as a borrower, have to come up with upfront to get the reno started. So on about $300,000, for example, you got to come up with about $45,000. Gets the renovation started, and the bank will then start funding you with construction draws done to basically get you to all this to completion. And then at the end, you're going to be then sitting with a normal bank mortgage that gets transitioned seamlessly. And so the big difference to a lot of this is as well, because people, yeah, I've done this with a construction mortgage. The couple big differences are it was never done likely through bank financing the whole way through. So even on those draws, you're paying competitive bank interest rates. The other thing is you probably didn't know the bank giving you your as complete appraisal, basically saying no matter what happens in the market, I'm committing to this number for you. And you didn't exactly know where your cash flow and your numbers were going to be because your interest rates weren't preset. This is all happening now. And so it gives the investor no more guesswork. It just becomes basically a formula that they can rinse and repeat with. So someone comes in, they say, hey, I want to buy this. Can I qualify? Yes or no? Let's get the appraiser out there. Let's see what it's going to be worth when it's done. If all those, then we check those two boxes, you know exactly how you're going to complete your project now.
And this appraisal that happens, so they can go to the property and see and say, hey, Lorenzo, there is no garden suite in the backyard. Yeah, because I didn't start it yet. But like they're looking at the permit. Are they looking
Correct.
at the drawings? Like what weighting are the appraisers kind of looking at for these?
So they're
things?
basically taking a look at what you want to do. So let's say you're adding a garden suite. They're going to go through the construction budget with you. They're going to take a look at how much money you're putting into it, what work you're doing.
So you have like a contractor quote.
Exactly, a contractor quote. And then they'll then look at comparables in the area. So let's say there's a couple other garden suites around you, for example. What are those values of those houses? And then they'll base it based off of that, as well as obviously your quote. But the way they know the work's getting done is like exactly like you said, the contractor quote. So we come into the bank now. We come in with, can we qualify? Can we get the contractor quote? Obviously, so get that quote, and that's the easiest part typically. And then obviously, can we get that as complete appraisal to come in where we want it? And the rest kind of is a pretty straightforward process from there.
So as long as you build it to like what you said you were going to do, that appraisal stands, regardless of what happens with the market or with like whatever.
Yeah, the bank's holding themselves to that value. We're getting an actual paperwork approval from them based on that. Let's say you're with all the work, it's going to be an $800,000 mortgage. You're getting an approval that says $800,000 on it. Now, the obviously renovation money gets released in draws. Yeah. So what will end up happening is the appraiser, every time you run out of money and we need another draw, will come out, figure out what percent complete you are, and release money based on that. But yes, as long as you're getting that work done, they will release the money.
And so they're not looking at like invoices from a contractor. They just want to see stages of work complete. Done.
Correct.
Because again, as a cheap Dutchman, I would want to do a lot of that work myself, whatever I could. And it's like, that's fine. As long as it's done up to code, and like the appraisers, obviously if it's shoddy work, you'd be like, this is not good.
Yeah.
But if it's good, then you get your money. So
correct.
And
otherwise you'd be a cheap Dutchman and a poor Dutchman.
Yeah, exactly. And yeah, so on the purchase price of the home, regular rules apply, right? So you're going to need 20% down.
If you're buying a rental, 20% down, exactly. So so it works on both. One thing to say, it works on both purchases and refinances. So if you have enough time to get your contractor quote done, if you need permits for what you're going to do, get the permits from the city while you're in that purchase or financing condition stage, then we can easily do it that way as well.
Yeah.
If not, what a lot of our borrowers are doing, we're closing on as a regular mortgage, again, with the bank. And then we're doing this as a quote unquote refinance, but adding that renovation loan after the fact, just because again, timing, most of the time, if you have a 5-day conditional period, most people don't have their quotes ready from their contractor, the permits from the city if they need it. Like, a lot of that stuff's not done, but we can do it on both.
Yeah.
And this is something too, just to give you an idea. It works all the way from a small, hey, I want to renovate my basement for 40 grand, all the way up to I want to demo my house and build a brand new custom home that's 5,000 square feet.
Yeah.
So this will work. Now, again, loan to value starts to kind of differ based on what we're doing in the location, but it works the whole way through.
Yeah. So if you're just doing a kitchen reno or something, this
will work.
Not as an investor, you just want to make your house better, it'll work.
Yeah.
Not that we necessarily recommend that. But
Yeah.
well, no, I mean, if you're going to take debt, make it work for you.
Yeah, well,
right?
we have cases
But-
too with borrowers, and we've kind of shown the examples where it's someone that is basically husband and wife, they're younger, they bought a house to move into, that's where they live now, and the cash flow's starting to get tight on them, right? Market's not great, like inflation's not great for them, so market's getting tight, and so they're like, I need better cash flow. What do I do? We use the renovation loan. They put a garden suite in their property or add a basement unit to their property. All of a sudden now, with some of these cases, we're saving people $1,000 a month. But the mortgage payments getting higher, their actual value of their home is going up as well. So the equity's staying about the same when we start, but now you're basically paying $1,000 less a month, and you're getting access to an additional couple $100,000 in equity eventually down the road that you've basically forced the appreciation on.
And this is with essentially
I'm
with
probably getting excited.
Well, I just want to say this is unreal. Like, this is really, really awesome.
Yeah.
It's a great opportunity.
well so if you're listening,
I
you're
can
like,
list
oh,
like
here's
50
another
different scenarios.
here's
This would be
another program from somebody who's trying to sell, because banks always have like, oh, we got this great program or whatever. Like, no, this is not that. This is a game
Oh,
changer.
this is good.
Well,
And-
yeah, you told me
so-
about this a week ago, and I'm like already got 2 deals, kind of like, oh, hey, we got to do this.
Yeah, it's one of those things too. And the biggest thing I like about this, it's not, hey, here's what we can do for you. Start doing all this stuff, and then we got to cross your fingers, hope it comes through. It's preset.
Yeah.
You know what you're getting. So, and to be fair, some people it might not work. And it will tell you up front, though. You're not halfway into your project and
Yeah.
then going, oh, this doesn't work. I'm screwed.
The
It's,
value
you
didn't
know
come
right off
through.
the bat. Exactly.
So one case that I thought would be interesting where this would apply. So a lot of first-time home buyers, they look at the market and they look at kind of like the threshold of what they can afford. And a lot of the times, like if they're just buying a single-family home, it's their income compared to the mortgage payment. Can I qualify? Okay, well, here's the limit on what I can spend, right? But if you add rental income into the mix, now all of a sudden I can qualify for more, right? So if I got a house that's already got a basement suite, let's say, now I can qualify for a higher purchase price. So with this program, like, can you take the rental income of the new, like, proposed garden suite or basement suite or something that you're going to build and then use that to qualify for the financing to build it in the first place?
Yes.
Okay.
There you go. The one quick answer. Yes.
All right.
But yes, exactly. So let's just say you're anticipating getting 20, the appraiser goes and says, hey, that'll probably rent for $2,500 a month. I can now use that in the qualification. So if someone thought they were tight on what they had just bought, I can now add an extra basically rental income component into their application to help qualify.
Right. So like, because one thing we don't want to say is like, hey, everyone go out, build all these projects, get saddled up with debt. But like for people who want to be strategic with their property and make the most of it, that could add more cash flow
Huge.
to their income. And it's like, maybe you wanted to do it 5 years down the road, but you can pull that forward and do it now. And as long as you can get that appraisal. So you obviously don't have a lease agreement in place, but they're just taking market rents.
Yeah, the
of
appraiser
what-
saying, hey, here's what
this is going to
market's
be a
renting
2-bedroom
for.
unit
Exactly.
in your area. Okay.
Here's what they rent for. Add that to the application.
And so on the like on the reno side, if you do it right, if you have the right property and you're smart about how you do it, essentially it's no money out of your pocket.
Effectively,
At the end.
Yeah, correct.
Up front, you said
A little bit.
15%.
Yeah, you need a little bit, but yeah, the bank gives it right back to you. So effectively, you're getting the full. Let's call it. I just use 300,000 because that's kind of most garden suites are around there. But $250,000, $300,000 is coming right back to you. So you're getting a complete renovation financed. So it's almost like you're putting zero money into something, and it's going to give you back $2,300 or $2,500 a month. Right?
Yeah, so
minus a payment. So let's just
Yep.
say you're netting maybe, I don't know, like 500, 400 off that little component, but you're basically adding an extra 400, 500 bucks cash flow, sometimes up to 1,000, depending on the situation, to your life for just a little bit of work, right?
Yeah.
So
Yeah.
in a sense,
And-
you might not even be doing the actual work.
And this is through like an A lender through
Correct.
a bank. Because I mean, we've seen these programs, and in the States, it's a little bit more common. But you're not paying bank rates. You're paying premium rates for this.
Yeah,
at
so
least while you're doing the work.
maybe we can let you go through kind of what's the alternative. Like, first of all, does this exist on the market, and like, how can you navigate that without calling Lorenzo? But the other thing is like, what's the alternative to doing this?
So
Like,
yeah, I have seen it exist on the market before. I've never seen anything like this, but I have seen small pieces of it in the form of like a purchase plus improvements. It's something probably a lot of people have heard of before. And basically what that was is, hey, I want to buy a property and do a small-ish renovation or upgrade to it. So it wasn't designed to just rip your house apart and add a complete new
it's
unit.
like I need 20 grand.
Yeah, I need 20 grand. I need 50 grand. They let it go up to like 100 grand now, most lenders, because things are just more expensive now. So they let it go up a bit, right? But I need a bit of money to get an electrical I want to fix. I want to put a new kitchen in, like little stuff like that. So there was small programs designed for this, but nothing on this scale set up for investors. It was typically someone purchasing a house, their first house to move into, and then they wanted to do it. But nothing on this scale for investors. So what investors were doing, obviously, if they didn't, so some of them had tons of equity in their property. They would just refinance their house, take the extra couple $100,000, use the money, kind of keep moving. So those were the ones that didn't really have a problem. But some of them just either just bought or didn't have much equity in their homes. And it was at that point, like I said, it was the beg, borrow, and steal method. It was, let me bootstrap the money together, go raise it from other investors. We talked about the promissory notes. Private mortgage here, private mortgage here. Hey, I have this, my principal residence has equity. Can I go get a home equity line of credit on that one to then basically start the work here? And so it starts to get a bit messy. We were doing it, but it's messy, right? And a lot of people are saying, oh, my principal residence is coming into play here. I don't want that, right? So it was a bit messy before, and always with the, hey, we've even helped people as far as, let's get two appraisals done, one done for the bank today, and one the appraiser thinks it'll be worth when it's done. It's not set in stone, but at least it gives you a pretty good idea. Yeah. But I mean, there was always some guesswork involved, right? And when the market's going up, not a problem, but when the market's coming down, not great, right? So our goal here was to either A, make it affordable to do so, B, take the complete guesswork out of it, no more problems on closing. That's one thing every mortgage broker, every time it's problems on closing. That's kind of the line. Is there a problem on closing? That's something nobody wants to hear, right? So that's kind of what our goal was, to kind of when this building out this helping with and kind of seeking out this program.
Yeah, no problems on closing, and then limited risk before you start your development.
Yeah, exactly.
Questions answered. Okay, yeah. Well, so one scenario I'm thinking, like young couple, they want to buy their first house. They want to have an extra suite with income. The properties that they're looking at are like, like let's say they want to live there for 20 years or 15 years, right? And they're like, I like this area, but there's nothing in that area that has a legal 2-unit or 3-unit property, but I kind of want the income and want some extra cash flow. Like they can step into any house essentially and create that through this program.
Correct.
Because a lot of these people don't have like $500,000 to buy a house and renovate it.
Correct.
Or access to that, right?
Correct.
So this is like a way of kind of opening that door to say, look, I can buy the house with the down payment I have saved up, right? Which I was planning on doing anyways. And then I can also build what I want right away and enjoy it and enjoy the benefits of like increased property value, rental income, like your own kind of like well-designed space that you like to live in, right? So that opens the door for that. Whereas that wouldn't be possible with it.
Yeah, it is exactly it, right? Yes, absolutely. It's one of those things I was telling a lot of kind of realtors we've been working with and stuff like that. It makes properties now, like they're buyers, and they are way more competitive when putting in offers now, because they're now able to see value in stuff that other people are not, right? So A, makes you more competitive, but B, the stuff that maybe no one's looking at, well, maybe now you can look at it, right? So all of a sudden where there's 0 buyers, now you might be the one. Right? When there's 15 buyers for a place, well, you might see the most value in it, so it's worth something a little bit different to you, right? So it makes you a lot more competitive as a buyer too in the market.
So, okay, so that's the build-up program, which is, that's crazy, man. What you mentioned, you got about 6, but
there's about six of them. So the next typical biggest one, we call it scale up. So our scale up program, it's still designed for investors either A, looking to build out their portfolio of real estate properties, or B, already have a huge portfolio of real estate properties. And again, these are all for residential style. We do have some commercial products out too, but the ones
you say huge, just not to scare away listeners, like how huge are we talking?
So so this program basically is designed it can finance up to 40 units with banks. So again, so someone has 10 fourplexes, someone has 40 properties, someone has like 40 units basically is what it can finance up to, all with major banks. And the advantage of it is obviously most investors, especially once they're past property 5, 6, 7, 10 plus, most banks are just say, hey, you're past 10, I'm out. Some banks even have 5, I'm out. So you'd right away typically run into a problem. Second biggest thing, obviously, for this program that's huge is most people, again, the traditional residential mortgage qualifying is very challenging for a lot of investors because it's based off the income they make and their personal debts, and then obviously the debts of the mortgage. They kind of a little bit of rent income, but not a ton. And then most investors, hey, I'm at property 20. Well, I don't want to work anymore. I don't need to. I got enough cash flow, right? I shouldn't have to keep my 9 to 5 or whatever, that T4 that I have, right? And so this program basically is kind of catered to them at that point and says, hey, listen, I can now use the cash flow in my assets. So it's called a DCR, or basically a rental worksheet that shows the cash flow of your assets or the cash flow of your real estate. And based on the cash flow, I can take a mortgage out on the property now.
Yeah.
So it's basically qualifying based on cash flow of the assets. So they'll throw everything in there. So they'll throw all your rentals. If you have a mortgage on your principal residence, they'll throw that in too, obviously, because you got to manage cash flow. But as long as the properties, your portfolio cash flows, you will get a loan.
That's
obviously they want a little bit of liquid fallback too. So there's a couple of little stipulations with it too. So it's like, obviously we have stuff to talk to your mortgage professional about. But
that's the question I keep asking the banks is, can you not just give me a loan based on the rental income of the property?
It's possible. Yeah.
Yeah.
So the answer is yes, it is possible.
They keep giving me a no. So I don't know why they give you a yes. Like,
he's better looking than you.
Yeah.
There you go. Like,
yeah. So again, that's incredible because I've talked to, I'm not one of those investors, but I've talked to plenty of them who are like, okay, so, the first 5, you're going to go to Scotia, and then they don't want to do more than 5. So then after that, you're going to go to, RBC or whoever, and then once you get to 10, like, oh yeah, we really got to start finagling it. So
we've always had that model of, hey, first 5 go here, second 5 here, third 5. We had a plan, right? Yep. But this kind of allows you to use the plan, but then also blow past the plan, right? Yeah. And so that's the part we love about it. Like, just to give you an example of one guy actually we helped today, because it was actually a pretty good story. He's been declined by everyone under the sun, and he's got $10 million net worth. We're talking like, so real estate assets, $10 million net worth. He's got 10 or 11 properties, barely any mortgages on. Like, again, it's literally a $10 million net worth. Barely. He's got one of the houses of $4 million completely paid off, right? So this guy's obviously doing well. They got some RSPs, he's got some money, but doesn't have much income, much taxable income. He's self-employed, he's a builder, he doesn't have much taxable income. Every bank's just said, get out of here, right? So he came into us. That service-wise, a normal mortgage qualification wouldn't work at all. Everyone's told him no. We were able to get him a mortgage, just exactly what he only wanted. About it was $1 million mortgage on one of his properties that obviously had a ton of equity in it, and we were able to get it done for him. And he's now sitting there. Instead of the original offer he had was, I think it was a 7.5% rate and a 3% lender fee for some private lender. He's now paying 4.5 and no lender fee. Right. So it's like changed his day, right? Interest only, like that's what he's supposed to pay before. Now he's on a regular mortgage, right? So little things like that, or it's been helping some people. I just never told no.
What's kind of changed behind the scenes, like with the banks or the lenders for this to materialize? Like, is this you guys just calling them up, saying, look, you got to do this?
It's a bit of both. Like, it's a bit of both. Obviously, us just calling is a big help. Obviously, it's not the be all and end all. A lot of it's too, like, we've had some history with our company now. So we've worked with some lenders and basically said, look, here's our entire mortgage portfolio that we've funded over the past 20 years. Yeah. Most real estate investors, no defaults, very few, like, I don't know, like barely any missed payments. These are the type of clients you're getting. These are clients with, so you're adding a client to your bank now that has good income, great credit. Like, our average credit score is probably higher than ever. Like, these guys see our average beacon score, that's a big thing for them, and go, holy, like, that's huge, right? And so, because again, these are all typically real estate investors in that case. And so a lot of it's them, and so kind of work with them to design programs like that. Some of them, it's stuff that they've kind of had written in the archives of the bank, so they were programs created but never used. And so we've been able to kind of uncover them. So that's a couple of them, right? And so stuff like that, where it's like, yeah, someone did come up with it, no one used it, no one cared to learn how to use it, and then no one marketed it. So some of it's little things like that. So yeah.
I think you locked some people in a room.
Our new office does have a dungeon in the basement.
So you figure this out. You're not coming out.
Yeah.
But no, that's that's good. That it's interesting to hear that you have a little bit of clout, but also, like, the banks are looking for business too, right?
Yeah,
like
exactly.
Yeah, I guess it's kind of a standstill, right? Like, nobody's doing things. Well, like the Canadian economy is just like based off real estate.
Yeah, that's one thing we were talking about last time, right? It's like, so you look at the US, right? They have a little bit of everything. They got people wanting to buy small businesses. They have people in every different kind of industry under the sun. When people, this is people, let's say a normal job, have investable income. In the States, on average, they'll invest it not just in the real estate, but they'll put into a couple different things, right? Small businesses are really big in the States. People starting small businesses, side hustles. In Canada, it's primarily just you have investable cash, either put in the stock market, some people do, or 85% of people almost have felt like at one point were putting it into real estate, right? And so that just drives Canada's basically economy is now driven based off of real estate, right? And so that's kind of something good for when things are going good. Obviously tougher when things are.
Yeah, I was going to say 85%.
And I'm not saying it's 85%, but I'm saying it felt like it at one point.
25% that put it in pre-construction condos. Probably should have put it in the stock market.
Yeah, but again, it's obviously not 80. It's not a provable fact, but it felt at some point. It felt like just everyone you talk to's got. Like, I think I saw a stat, and it was like the average Canadian was either almost at one house like per person, or like owned, or just over. It was like getting close to like the number one, and that's like crazy high. Right. Yeah. So like, because you get like obviously a number of people, just investors were going crazy, right? And good, like in a good way. But obviously it's when your market economy is a macro level, if I'm sitting there as Carney or whoever, if my economy is just riding that real estate bubble, it's not a good thing.
Well, we had that stat at some point, and it was something like 45% of Canada's economy revolved around real estate. Yeah. And so that, including finance and construction, all that stuff, which, as a country is like, that's crazy because that's internal, right? I would rather have a lot of our money come from external, and sure, like the States, sure, big service economy. Yep. That's great, internal consumption, but they also have a lot of external investment. And that's one thing we've seen in Canada, right? Like direct foreign investment.
Well, we're turning it down. From last time, we're turning down when you come in. So I don't know if you guys saw that one. But
there's no market for natural gas, is what we heard the former prime minister say. Oh. And just the other day, the first natural gas tanker, I never saw that, left from Kitimat, BC, to South Korea.
No way!
What a incredible moment for Canadians.
Where's it going? There's no market. Where's it going?
Well, it turns out there is a market actually.
Oh, got it.
Well, I was gonna say because they made us build houses with no gas hookups because they all hydro.
Exactly. No natural gas.
Yeah,
it's been demonized. Anyways, we're getting way off track into the weeds here, but some of our pet peeves. Okay, so we got build up, we got scale up. Was there another one?
So yeah, the other big one is we call it Stay Flex, and so this one's obviously for a lot of people for a guy like yourself.
Pros,
Yeah, it's for a guy like yourself. So Stay Flex is for people who own short-term rentals. So typically the Airbnbs, the Verbos, any short or mid-term rental have traditionally been almost impossible to finance with the banks. So we are able to get these done now when it's outwardly. So a lot of people sometimes were getting it done with banks and the bank didn't know it was a short-term rental. But if the bank found that was a short-term rental, you were getting axed, right? And a lot of people probably have dealt with that. So you've been able to obviously get these done now as well as outward Airbnbs or short-term rentals.
What was their concern about that?
The banks don't love to finance what they call hotels.
Right.
And so because there was short-term stay, they again, not that this is right, but from the bank's perspective, it's all about quote unquote risk. And so if you don't know who's coming and going, then obviously the condition of the property becomes a problem. And then B, obviously, is there even a market? Can this, how do I know someone's going to keep renting it every day of the month? Right. And so for a long time, it's let's see a proven track record of Airbnb working. Now it's been working forever, so it takes forever for the banks to kind of come on to this stuff.
All the bank executives are traveling, staying in
Airbnbs. Yeah, no, that's the whole thing, right? But no, they won't touch them, but they love them, right? So
they're probably working out of an Airbnb.
Yeah. So it's been something that we've been working with. And so, yeah, we are able to finance kind of outward Airbnbs now. And so a lot of people say, well, what do we do with the rental income? Because that was always a big hurdle when trying to qualify. And so now what will happen is if you have a 2-year history of the rents being basically your overall rental income on that Airbnb property, I can get the bank to use that. Or if we don't have that necessarily yet, we've actually been able to get appraisers now to go out and do a market rent analysis as a short-term rental on the property.
So that means it works for a purchase.
Works for a purchase or refinance. Exactly. So if someone wants to now say, hey, I want to buy this and use it as an Airbnb or a short-term rental of whatever sort, the appraiser can now go out and say, okay, here's what your basically average monthly cost or monthly rent for the night's going to be. And here, or average nightly stay or nightly room is going to be. And then here's what your basically vacancy rate probably is per month. Figure out what the monthly rent will be, the market rent for that Airbnb every month. And we can use that toward qualifying now. So when before maybe we were using $2,000 to qualify on a single family home for rental income, we're able to boost people's numbers now because now it's $3,000, $3,200, $2,800, whatever that increase is. So it's helped on the qualification side of things. It's helped obviously getting Airbnbs financed. Some people on refinances wanted money out of their Airbnb, and the bank goes, "Oh, I can see on Airbnb. Sorry, I found your property on Airbnb."
Yeah.
Appraiser went out and told me it was a short-term rental. Sorry, right? And so we've had tons of those problems over the past, and so now it's something that we've been able to kind of get around. There is a cap at 75% loan to value on it. So it's a little bit of a bigger cap for investors. So traditionally, if investors buying a property, 20% down. If it's an Airbnb, and it's an outward short-term rental, then you're going to 25. But yeah, I mean, it's a pretty decent trade-off for people who've had disasters trying to finance that their entire life.
Yeah, 100%. So yeah, that kind of gets me excited. Yeah. I mean, on one hand it does. On the other hand, we see government regulation just choking all the short-term rentals.
And that's the thing. It's coming in a little bit late because obviously now
where do they all go?
Yeah, where are the short-term rentals now? There's not tons.
Yeah.
Right.
I mean, there's still a lot of people operating, but it's getting tougher and tougher. But again, for that sort of model of the first-time home buyer, I think this is fabulous. Yeah. Because that regulation pushes a lot of people out of the market, investors in secondary homes, like investment properties. But for your primary, as long as you get the license and everything, you can do a short-term or a mid-term rental, and it's perfect because a lot of the competition, and this is what we're seeing in our portfolio as well, is that the people, because we still manage some for people in their primary homes, because they just don't want to deal with that, the business side of it. Yeah. And they're busy as anything. It's crazy busy. So for especially young couples, this is a great option.
You can combo it too. You want to build a second unit. All of a sudden, we want to obviously there's some finagling. It's not all with one bank, but we've done combos for people as well, where you take two or three of the products, put them together, so there's possible.
So if there's any listeners who have 75% loan to value portfolio of 40 houses and want to build 20 garden suites and convert them all to Airbnbs, you got a plan.
Yeah. There's a rule: after you use 3 in a row, you got a problem.
Okay. Well, that's great. I think this is going to be a huge. So it's a buyer's market right now.
Yep.
I would say so. My opinion.
Yeah. If you have been sitting on the sidelines looking at what to do, I think this. It's a buyer's market, and it's a great financing opportunity. And if you can create the property that you want with Airbnb or construction or whatever, this is a great moment to act, right?
Yeah. Well, just read the headlines, right? The crash has come. We told you so. Real estate is blah blah blah. Just when you start on the flip side, right? When everybody's "Oh, it's going to go up forever," you're well, you got to be cautious now. Yeah. Right. But now I think, like you said, it's a buyer's market. You can tell from the headlines. Yeah. It's almost just waiting for Jim Cramer to say "Oh, this is a bad investment." Okay, you got to buy that one,
perfect.
Right?
Yeah. Oh, you see, listings are there's more listings year over year. This year, a crazy amount more. Less buyers, less transactions happening, but more listings. So it's simple supply and demand now.
Yeah.
Yeah, incredible. Okay, what else, Brent? Did you cover? Lorenzo, is there anything you wanted to?
Not much, no. Definitely got those are the 3 big ones. So we'll be releasing kind of all the programs as well. So, but those are the 3 big ones, I would say. And so it'll be good. We're excited for it.
Wish you all the best too, because that is, I know it's a lot of work on the back end to get all these things to materialize. It's exciting when it comes out.
For no guaranteed results, right?
Yeah.
Well, that's the gamble you got to take sometimes, right? And so that's our job, though. I guess I would put it that way too, right?
Yeah, and to reiterate, mortgage brokers, how do you guys get paid?
So typically we get paid by the banks directly. Depends on how the deal is financed and structured. So every deal is a little bit different, but generally the bank will pay us a finder's fee. So it's free for the most part for people to to apply through us. And then sometimes obviously there's situations where a lender doesn't pay us for whatever reason. And then we will have to charge a fee just to obviously cover our expenses, but no fees are done up front. It's always something where if there is a fee for whatever reason, it's done on the closing date when you know you got your money too.
Yeah.
So so call us 100 times. There's no cost to keep calling. You want to apply 400 times, keep going at no cost. We have clients where we've been running pre-approvals for them for 2 years, just updating it constantly because they're looking for the right deal, right?
Yeah.
And it's something we keep helping them, and obviously at some point they'll hopefully buy. And yeah.
I just want to comment because I've kind of gone both routes. Like I've worked directly with lenders and then also through you guys and other mortgage brokers, whatever, just trying to get a sense of, the different services and whatnot. And yeah, definitely mortgage broker in my experience has been an advantage, right? Because you kind of have a bit of a strategic angle on what's out there, what's current, like where to take, my file or like whatever client it is, right? And what your situation is, and just say, look, like we've done 50 of these last month, like we know exactly where to go to make sense, right? And if you talk directly to your bank, like you can leverage your relationship, that's good, and sometimes that makes the most sense, but they only have their options, right?
That's exactly what
they might not think strategically about this. So it's definitely good, especially if you're an investor or investor oriented. Like, yeah, you want to have that guidance, right? So
I'm just waiting for Lorenzo to say it. Just waiting for the thing that all the mortgage brokers say. It's not always about.
Oh, you want with the rate? Is that what it is? Yeah. It's funny actually. Okay, I'll drop one. One of the programs that come out is we call it the Investor to Edge Rate Guarantee. So we do. So I will say this to your point. We are coming out and guaranteeing that any rate from any other mortgage broker, we will beat it. So if someone's got a competing offer from another mortgage broker,
that's big. You should have said that off the top.
We'll come in. I don't know. We'll come in with the price. He set me up. That's why.
By the way,
So yeah, the one thing. So any competing offer from another mortgage broker, we will either guarantee to match or beat it. So it's about rate too.
Wow. Okay.
It's about rate too.
It is about the rate. It is. No, I hear it all the time from mortgage brokers, and there's a kernel of truth, but it ain't all that. So okay, that's pretty cool.
There you go.
Cool.
See.
So where do people go to get these great programs and these great rates?
So yeah, best thing to do is reach out to us. You can get to us at www.bmselect.ca. So that's our website. I have all of our contact info there. You can email us, call us anytime. And reach out to us. Myself, my partners,
check it in the show notes.
Perfect. Yeah. So email, call. I put all my contact in there, and I'll be happy to have chats and kind of assist where we can.
Ontario only?
No, Canada-wide.
Okay.
Yep.
Canada-wide. Okay. Awesome. Cool. Well, thank you so much, Lorenzo, for coming in a second time. We got it all this time, so that's good. And to our listeners, thanks for listening. Reach out to BM Select. And until next time,
steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
If you like my voice better, click share.
If you like both, give us a 5-star rating.
To learn more about the show, head on over to twostewards.ca and explore our free resources. To interact with the show, feel free to reach out at hello@twostewards.ca.
We will see you in the next episode. In the meantime, steward your wealth wisely.
Nailed it.